The other big aspect of this year, and that's been the change in the interest rate regime. Started in 2015 and now we're down 175 basis points if I'm not mistaken. How is this going to impact asset classes and the way you'll manage your wealth as we step into 2017? Feroze.
See, I think interest rate is one of the variables which does not only influence debt. It actually has the power to influence other asset classes.
Yeah.
So point one, how will it influence debt? Whatever the money had to be made in a falling interest rate regime, using debt funds is already behind us.
Okay.
So moving forward, would you make too much money on interest rates falling in a bond fund? The answer is a no. Okay. And unfortunately, your monies which are there in fixed deposit, which don't get benefits of falling interest rates, only get hampered when interest
because your return is falling.
So in debt, there's no portion, either fixed deposits nor bond funds will you make you money. Point two is every time there is an interest rates coming down, there's a flight of capital from debt to equity. So equity markets get propelled. Now, unfortunately, that has not happened in the last year, and fortunately for 2017, it has not happened. A falling interest rate year, generally in the past, if you analyze the last 20 years, whenever interest rates have fallen, those years the equity markets have given 18-20% return of this quantum if there's interest rate fall. So it's very good news for somebody who's sitting on the sidelines because interest rates have fallen and that impact has not been transformed into equity market gains. So it's still waiting to happen because there's been a lot of overwhelming news and uncertainty of unprecedented steps like demonetization. So the markets are down. So point two which I'm making is it's very good for equity what has happened, but that's still not behind us and it's still stored in the market. Point three, I think real estate should have ideally got a benefit of this fall in interest rate.
But has its other problems.
Other problems which it is grappling with. So I think equity will be the asset class for 2017 because you've had a good news but not factored in. Debt had a good news, bond funds had a good news, but it's already factored in. Real estate has a good news, but there's enough bad news to undo it.
On equities, quick last point, since we're talking about creating some wealth in 2017, and here's something interesting. So for just this episode, for now, we're going to say that you're looking at an investor who's willing to take on as much risk as possible. Age is not a constraint. Other sort of liabilities are not a constraint. If you were to create a maximum wealth generating portfolio for 2017, how would you go about the asset class mix?
See, I think if somebody has to create maximum wealth, so debt is certainly not going to be a portion of that. In my opinion,
at all?
Not at all. Because especially for 2017, if you're speaking about some periods, I know it's a little aggressive, little contrarian, but I don't see merit of having debt in the portfolio currently if you have to maximize the return. If that's the objective and you're keeping the objectives and goal setting, which is the conventional mindset of personal finance, aside for a minute. So if you come to that, equity 100%. If equity is 100%,